Insurance is quite interesting topic in commercial arithmetic subject. My dear students, I'm Dr. Prajna Mattihalli, Government First Grade College, Dharwad, Karnataka. I welcome you all to this video of mine, wherein I have explained theoretically what is insurance and many technical terms which we come across in case of insurance. I have also solved some problems which are expected you to solve in examination. So let us understand the topic. Insurance, first let us understand the meaning of it. Insurance may be defined as a cooperative device to distribute the loss to an individual by pooling or averaging out of a common risk. The heavy loss to an individual or to his property from unpredictable and uncertain contingencies as death by accident or illness, disability or natural calamities like earthquake, fire, flood, etc. is minimized by insurance. So my dear students, human life is quite uncertain. Anything may be there for us in our future. We can't predict it. Human life is quite unpredictable. Therefore, there are possibilities of many types of damages. Our health, also death, even goods, everything is exposed to the risk of damage. Therefore, we the human beings are interested in insurance. Insurance compensates the loss which is occurred just by unpredictable events. There are two types of insurances: life insurance and general insurance. Let us understand in detail about the life insurance in this video. In my next video, I am going to explain you about the general insurance. Life insurance, it is a contract under which insurer agrees to pay certain specified sum to the insured on the death of the latter or on his attaining a particular age, whichever is first, in consideration of a periodic payment called the premium. I hope you know in real life how the life insurance is. Here, there are some insurance companies. They are called as insurers. And we, the human beings who are taking the policies, are called as insured. It is a contract between insurer and insured, insurance company and human beings. Here, we are taking the policies on the condition that in between the term, every insurance policy will be having an exact specified term, like 10 years, 15 years, 20 years, 25 years, 30 years. This is term of insurance. In between the term, if anything happens to the life of the insured, he gets the amount assured. If nothing happens, he is still alive after completion of the term, even then he gets the policy amount in case of life insurance. Premium. The amount of premium payable depends on the sum assured, period of the policy, age of the person, mode of payment, and the type of insurance desired. There are many types of insurances: whole life policy, endowment policy, money back policies, and benefit, double benefit policies. Like this, so many types of policies are offered by the life insurance companies. Here, amount of premium will be decided by sum assured. If sum assured is 1 lakh, premium will be paid. If it is 2 lakh, then double the premium has to be paid. If it is 5 lakh, then 5 times of the premium has to be paid. So it depends upon the sum assured period of the policy. If period of the policy is shorter, 5 years, 10 years, then the premium will be heavy. And if the term of the policy, that is period of the policy, is longer, 25 years, 30 years, then automatically premium amount will be lesser. Age of the person is also important. If he is younger, premium may be lower. And if he is older, then automatically the premium amount will be heavy. So mode of payment, one can pay monthly. The premium amount can be deducted in salary, or he can pay it in insurance office. That is monthly, quarterly, that is 4 times in a year, or half yearly, 2 times in a year, or annually. So mode of payment is also important. If it is annual policy, then there will be rebate in the premium. If it is half yearly policy, then also some rebate will be there in the premium. If it is monthly, then he has to pay little more premium. And the type of insurance desired is also important for deciding the premium. And what is paid up value? Suppose a policy holder has kept the policy in force for at least 3 years. That means he is paying the premium regularly for 3 years. Then it is called as policy is in force. Subsequently, he doesn't want to pay the future premiums. Then he can convert the policy into a paid up policy. When an eligible policy is converted into paid up policy, the paid up value is calculated. How? There is one formula for it. Paid up value is equal to number of years premium paid divided by term of the policy into sum assured plus bonus. That means, suppose we have paid the premium for 3 years. Total term of the policy, that is 15 years. And sum assured is 1 lakh. Then the calculation of paid up value will be number of years premium paid, that is 3 years, divided by number of, that is term of the policy, that is 15 years, into 1 lakh, sum assured. So 3 upon 10 into 1 lakh. Then the paid up value can be calculated. And how the surrender value is to be calculated? What is the surrender value? The cash value payable by the insurance company on termination of the policy contract at the end, at the desire of the policy holder, but before the expiry of the term, is known as surrender value. That means, suppose term of the policy is 15 years. That is, after 15 years, it is called as expiry of term. But after 5 years or after 10 years, now the person, the policy holder, wants to close it down. He wants to take the money then itself. Now itself he wants the money. The cash value payable by the insurance company on termination of the policy contract at the desire of the policy holder before the expiry of term, in between itself, he wants to take the money back. Then it is called as surrender value. A policy can be surrendered provided the policy is kept in force for at least 3 years. At least 3 years one has to pay the premium amount. Then it is called as policy is in force. Then you can go with surrender value. So how it is calculated? Surrender value factor will be there. And paid up value, we have understood how to calculate the paid up value. And accrued bonus will be given every year. Insurance company will declare the bonus that will be added and it will be multiplied by surrender value factor. Then the money will be given back to the policy holder. Friends, now let us solve problems. We have understood the theoretical aspects. It will be more clear only when we solve the problems. A person takes LIC policy at the age of 22 years. The person is at the age of 22 years for a term of 12 years. Okay, that is the term of the policy. The sum assured is rupees 5 lakh. Premium is calculated at 100.84 per 1000 per year. The rate will be usually for life insurance. It is not percent. It is per 1000. Find the amount of annual premium. How to calculate it? See here, if the policy amount is 1000, the premium will be 100.84. Now the policy amount is 5 lakh. So we have to calculate for 5 lakh. That's all. Premium for 1000 is 100.84. For 5 lakh, how much? So 5 lakh into 100.84 divided by 1000. So 5 lakh into 100.84 divided by 1000. Then if the calculation is done, the answer will be rupees 50,420 rupees. This is the annual premium. If he is going to pay for half yearly, then half of the premium has to be taken. If he is going to pay quarterly, then 1/4 has to be made for this premium, which is annual premium. And you will be getting the answer for quarterly. If it is for monthly, again it should be divided by 12. I hope you have understood how to calculate the premium. Find the paid up value of policy without profit of rupees 1,20,000. That is the sum assured or the policy amount. In force for 9.5 years. Policy is in force for 9.5 years. The premium is being paid. If the period of the policy is 20 years. What we have to calculate? Paid up value. What is the formula for the same paid up value? That is number of years premium paid divided by term of the policy into sum assured. That means how many years we have paid the premium? That is 9.5. And what is the term of the policy? That is 20 years. What is the sum assured? That is policy amount 1,20,000. So paid up value is equal to number of years premium paid divided by policy term into sum assured. 9.5 divided by 20 into 1,20,000. And by calculation, we will get 57,000. What is this? Paid up value. That is 57,000. Find an agent's commission at 25% on the first year's premium for a policy of rupees 60,000. The rate of annual premium being rupees 38.25 per 1,000. So rate of premium usually will be given for 1,000. That is 38.25 per 1,000. Now the policy amount is rupees 60,000. Okay, so policy amount is 60,000. We have to calculate the premium for the same. For 1,000, the premium is 38.25. For 60,000, how much? Then after calculating the premium, we have to calculate the commission on premium. So agent's commission will be calculated on premium. That is 25% on the annual premium, first year's premium or annual premium. So here, let us calculate the commission is to be calculated on the annual premium. So let us calculate the annual premium first. Premium has to be calculated like this. Here, the rate of premium is given, that is 38 rupees 25 paise for 1,000. So for 1,000, 38 rupees 25 paise. For 60,000, how much? 60,000 into 35.25 divided by 1,000. Then the premium is 2,295. So 2,295 is the premium. On this premium, commission is to be calculated. That is 25% commission. 25% on 2,295. That is 573.75. That is the commission. So my dear students, in this video, we have understood life insurance policy and certain technological terms in this life insurance. That is, what is premium, what is paid up value, what is surrender value, we have understood. And the problem also being solved here, problem of calculating commission, problem of calculating paid up value, and also how to calculate the commission on premium. These things are understood by us. So I hope you appreciate this video, which is on life insurance. And in my next video, as I have already told, we are going to understand about the general insurance, which is very important from the point of view of examination. Thank you.